Welcome back to Smart Money. Very interesting discussion on what's been ailing the banking stocks. The same set of stocks that were the biggest performers last year have now become huge underperformers, with the Bank Nifty down 7%. We have, of course, two analysts who've tracked this space for over decades. Vishal of UBS, we have Krishnan ASV as well. Krishnan, before the break, we were talking about how Indian fintechs could disrupt existing banks. I mean, that's been the narrative, although there is no existential threat just yet. The fintech world is very small at the moment, but do you think it poses a challenge for banks?
Yeah, so not an existential challenge, Sonia, but yeah, I mean, there are definitely profit pools where they start to make a dent. Also, I think the RBI's directive and norms around digital lending guidelines have been fairly elaborate. Essentially meaning that the fintechs will now have to grow in a very regulated, very calibrated environment. So to that extent, I don't see an existential challenge, but there's always a lot to learn in terms of agility, in terms of what the larger banks can pick up, both in terms of customer friendliness as well as agility. There's a lot for the fintechs to learn as well. I don't think they understand how to operate at scale. So it's not been a very easy journey for even the listed fintechs yet. So I would think there's a lot to learn for both sides, but definitely advantage larger franchises. Yeah.
Okay. Vishal, I wanted your thoughts on this. I know you don't track the fintechs very closely, but there's so much for banks to catch up to, right? Whether it's online payments, online lending, digital disruptions, and some of these small fintechs are doing it really better, especially targeting the younger generation. Do you think at some point it's going to start to show up in the earnings, or it's too premature to make that assumption?
Yes. So I think there are a couple of issues which banks will have to deal with. One, clearly it pushes them to spend more, right? And we are seeing almost all the private or even PSU banks investing on UI, UX. They are trying to build teams which are similar to fintechs, or offering an environment which attracts this engineers and the new generation which works on these solutions. So that process is already happening, and it's already reflecting in numbers in form of higher OPEX. That's number one. The other bits of fintech, for example, payments you mentioned. Now, payments with UPI, I think a large part of threat is already behind, in my view, because UPI is as seamless as any other payment solution which can come through. And banks anyways are owning that. In some sense, it has to go through the accounts. So that's there. The other two places which, could have been a threat or can still be a threat is one, lending, and second, cross-sell. I think on the lending side, we've seen RBI clearly being very clear in terms of regulating, requiring, capital, or you basically build your own balance sheet, which effectively limits the size of fintechs. It has to go finally to the banks. Second is cross-sell. Yes, I think on cross-sell side, fintechs have a much better opportunity because they are very good in acquiring customers, and therefore their ability to cross-sell could be slightly better. And that is the fee pool where they could put some pressure. But if you again look at cross-sell fee pools, except insurance, I think like bulk of the other pools have already shrunk. And insurance is extremely difficult one to be done purely digital. So net, as I said, it clearly pushes banks to up the ante in terms of, spend more. Yeah.
Okay, got that. But I guess, it may take some time to make a larger impact, right? So far, it's very nascent in terms of a threat for banks. I understand that. But the larger question, Vishal, is that what stage of the business cycle are we in? Is this a mature stage of the banking up cycle? Is the best of the banking up move behind us? What's your best guess?
I think we are in the early stage of a business cycle. So the way, when I say early stage, stage one is already crossed, which is significant decline in credit cost and therefore significant improvement in return ratios. That's already behind. Now we are in a phase where banks can actually enjoy compounding benefits of their low credit cost. And the reason I feel credit cost may remain low for a considerable period is the leverage in the system. So if you look at the leverage in general, actually has gone down in the last 6-7 years. That gives a good platform for banks to grow credit and compound, on equity.
What about you, Krishnan? What do you believe is the stage that we are in? Do you also think that banks are at a stage where they can compound their growth now? And can the current loan growth levels be sustained in the medium term, even if they're not sustained in the near term?
Right. So purely in terms of stage of the cycle, to be very honest, I think the easy money stage is probably behind. Now, the larger franchises clearly have an advantage. We are in an environment where there is a scramble for deposits, and this will accrue. I think the market share gains will probably accrue to the larger franchises, the more solid deposit franchises now. That kind of drives our pecking order within the investment universe. That's number one. Number two, purely in terms of having put that stage of say the business cycle. In terms of loan growth, I think we need to probably adjust to a new normal in the next 6 to 12 months, 6 to 18 months. I think we are looking at maybe a 12 to 13% kind of a loan growth for the system. That would be lower than where we are today at 16%. The peak, as I said, peak growth is behind us. I don't think we are adjusting to that anytime soon.
Okay, so peak growth is behind us. That seems to be the summary of the discussion, right? That there is perhaps a slower growth coming. I know both of you don't want to talk about individual stocks, but I'm going to ask anyway. SBI, I think, was the big mover last year, and that stock is now down, 16% from its highs it saw last year. Krishnan, do you think this is a great opportunity for long-term investors to buy SBI if they missed out on the rally earlier? Or are you cautious given that you expect peak growth is behind?
No, so as I said, I mean, it's been one of our top two picks, and both of those, ICICI Bank and SBI, we see comfortable headroom emerging now after the recent bout of correction. So we'll be fairly comfortable holding on to our buy position there. Yeah.
Okay, so Krishnan ASV saying fairly comfortable holding on to the buy position in ICICI Bank and SBI, especially after the fall that the stocks have seen. Vishal, parting thoughts?
I think it's a good time to own banks from a medium to long-term position. In the near term, however, as I said, you have to be a little bit cautious just because the expectations of, on growth, etc., are already very high in the quarterly numbers. So with that, I think,
Okay. All right, gentlemen, thanks a lot for joining in. Pleasure speaking to you in a very succinct way. We sort of wrapped up how, banks are doing at the moment, why there's so much pressure, and what do you do with the stocks. With that, it's a wrap on this edition of Smart Money. Thanks a lot for watching.